Good morning and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live throughout the day from Philadelphia at Nasdaq and Villanova University's Business School ETF Synapse, where we're focusing on academia and research in the ETF space. Joining me for this segment is Jordan Farris. He is the Managing Director of ETF Product Development over at Nuveen, and we are actually on a panel together later in the day talking about the future landscape of ETF research. Your focus is going to be on ESG, so to kick it off, what is ESG? It sounds like a very big umbrella these days.
It is a very big umbrella. There are a lot of terms, there are a lot of acronyms that are being thrown around, ESG, SRI, impact investing, but ESG really stands for environmental, social, and governance. And there are a variety of different factors that we can incorporate into the investment decision-making process that identify companies that are doing a good job managing their ESG risks. And we can use that in the decision-making process to incorporate essentially personal values into investments, but still deliver a good risk-return profile for investors.
So what are some of the key points you're going to focus on when we speak later in the day?
So I'm going to talk a little bit about the evolution in this space. So for a long period of time, we refer to this as SRI, or socially responsible investing. That really was an approach that looked at excluding companies that we would define as sin stocks. So you can think of things like tobacco or gun stocks, civilian farms, manufacturers, et cetera. We still do have that exclusionary approach, but in addition to that, we're looking for best-in-class inclusionary tactics. So this is where ESG comes into play. 20 years ago, we could only define those sin stocks as what industry they're in. We don't like that industry. We don't want to invest in that industry. Now, with ESG, I can look through a data-driven lens. I can pick companies that are doing better against their peers along those ESG metrics. So I can look at tech companies, and I can pick the tech companies that are doing a better job managing their human capital, that have a better board structure. I can pick energy companies that are doing a better job managing their toxic waste or their water stress. And I can include those in the companies. That allows us to provide a very diverse exposure for people, so we can still provide the risk-return characteristics that you typically get from a regular non-ESG branded product. But investors can now incorporate their personal values into their investments. So
it sounds like companies that are under this ESG umbrella sound like they would operate better than ones that aren't. So do you see better performance with ESG companies versus non?
There are periods of time where we've seen incrementally better performance. So with a lot of the ETFs that we're bringing to market, we're simply trying to offer beta exposure. I'm trying to offer a large cap growth exposure or mid cap value exposure or small cap blend, something like that. The tools that investors usually use to build a complete asset allocation. Now, there have been cases where there has been incremental outperformance or alpha that's been driven by selecting these companies. But what we're really trying to do is enable people to invest with their personal values without disrupting an allocation that's already set up for them.
Is ESG regulated? Is there a certain data set that you can select from? Like, what if I think a company is running well and you don't? Because some of it can be arbitrary.
Exactly, and that's an important point to touch upon. So there are a number of different data providers that will provide ESG data. It's not regulated, but I think it's very important. This is why I like the ETF as a delivery vehicle for ESG strategies. It's important to understand who the data provider is. We happen to use MSCI as our data provider for ESG and low carbon data. You can understand what their methodology is. You can understand how we're incorporating that into the strategy. And with the ETF wrapper, we post our holdings every day. So you can see point in time, do I own this company or not? It's in the news for a negative thing. Do I own this company in my portfolio, or was the methodology successful in excluding that?
And to wrap up, do you think that ESG is going to continue to be on the growth trajectory like it is now, or is this just a trend?
I think it's going to be huge. My firm Nuveen has been in this space for about 5 decades. I would also encourage investors who are looking to get into ESG investing to look at the firm that's bringing products to market. You want to have a firm that understands the data sets that are out there and understands how to apply the ESG data to an investment product. I think this is only going to continue to get bigger as the millennial generation and also women investors are very interested in this. Millennials, this is something I learned this year, the upper age range for millennials is in the upper 30s. I think a lot of us tend to think of millennials as in their mid-20s and not having a lot of money, still living with mom and dad, et cetera. But a lot of them are very well established in their careers, starting to make money, they have dollars to invest. That's just going to continue to grow.
All right, thank you so much for joining us. We'll see you later on the panel.
Thanks, Jill.
And thank you for joining me throughout the day from Philadelphia. I'm Jill Malandrino, Global Markets Reporter.